textbook definition of liquidity says it is the ability to pay current liabilities using your current assets. And recently I came across another very interesting definition of liquidity, and it says liquidity, that's when you look at your financials and wet your pants. This is reading 29th, Sources of Capital, and we are doing LOSB. The LOSB requires us to describe primary and secondary sources of liquidity and factors that influence a company's liquidity position. And we begin by asking a question. The question is, what is liquidity? Liquidity refers to the efficiency or ease with which an asset or a security can be converted into ready cash without affecting its market price. The most liquid asset of all is cash itself. And then in line come the tangible assets. Okay then. Now what is liquidity contingent upon? Or what is liquidity dependent upon? The answer is the degree of liquidity is dependent upon two things. A, the type of assets, that is, nearer the number of assets to cash, more liquid is the company. And B, convertibility of the assets. The speed at which the assets of a company can be converted into cash impacts the liquidity of the company immensely. For example, the short-term assets like temporary investments and stocks can easily be converted into cash. So more the number of these assets, more is the liquidity of the company. You can convert the temporary assets into cash immediately, whereas it may take a few weeks to convert the accounts receivables to cash. If the need arises, the long-term assets can also be converted into cash. But one, they are not easily convertible. Conversion may take some time. And two, they put certain cost on the company, as it may damage the financial and operating strength of the company. Okay, that's cool. Then what are the sources of liquidity? There are basically two sources of liquidity, the primary and the secondary sources. The primary sources of liquidity include cash or near cash items that can easily be converted into cash to generate liquidity at a very low cost. Some of the primary sources of liquidity are A. Cash balances, including the bank balances. These are the items that are shown in balance sheet as cash and cash equivalents, which include the short-term securities having maturity of less than 90 days, apart from the cash and bank balance. B. Short-term funds. These include accounts receivables, bank credit and other short-term securities. C. Cash flow management. Cash flow management refers to the ability of the company to manage the liquidity and cash flow effectively and to manage the level of decentralization of cash flows. Now, what are the secondary sources of liquidity? These are the assets that provide liquidity to a company at a higher cost and impact the financial and operating stability of the company. These are those sources of cash that are liquidated once the company has exhausted its primary sources of cash. Some of these secondary sources of liquidity are A. Negotiating debt contracts. A company can negotiate its debt contracts for repayments, its timing and size, interest rates, etc. By extending the repayment periods, a company may increase the liquidity. B. Liquidating long-term assets. A company can sell off its long-term assets such as investments, real estate assets, plant and equipment, etc. in case it runs out of primary sources of finance and is in a dire requirement of cash. C. Bankruptcy protection and reorganization. Here, the company can file for protection and hence the law puts a restriction on the amount that the company must pay off to its creditors. And the reorganization involves restructuring of company's finances. Moving on, what are the factors that negatively impacts the liquidity position of a company? Drags and pulls are the factors that negatively impacts the liquidity position of a company. A drag on liquidity refers to delay in receipts, while pull on liquidity refers to acceleration in disbursements. We'll first discuss what some drags on liquidity are. The drag on liquidity is there when the cash inflows struggle and the company have difficulty collecting its debt. Some of the major sources of drags on liquidity are A. Uncollected receivables. Sometimes the companies, under a pressure to increase the sales, compromise the terms on which the sales are made. This compromises the collectability or receivability of payments. Once the receivables or collectibles begins to pile on, the liquidity position of the company begins to look a little shady. This causes the drag on liquidity. You can easily identify this in the financial statements of the company, and it can be seen through the financial statements and an analysis of balance sheet trends. For example, a deterioration in days sales outstanding or DSO ratio is often an indicator of negative developments acting as a drag on liquidity. Also, increasing levels of bad debt expenses are also a good indicator to identify the issues in collection of receivables. Now B. Inventory obsolescence. So when the inventory of a company is turning obsolete, it means that the company is finding it difficult to convert it into cash by the means of sales. Thus, it acts as a drag for liquidity as there is less cash flow than expected. And not just the low level of inflows, but the low conversion also leads to increased cost in terms of storage cost. And a good indicator of increased inventory obsolescence is decreases in the inventory turnover ratios. Now the third drag on liquidity is the tighter credit. So when there is a reduction in the amount of credit available to a business from banks or other financial intermediaries, the inflows of the company suffer a hit. The credit limits may also get hit due to other factors such as decreased credit worthiness, unfavorable trends in industries, or macroeconomic conditions such as rising interest rates or recessionary environments, etc. Next, we'll discuss the pulls on liquidity. The factors that act as pull on liquidity are high frequency of cash outflows and reduced access to financial and commercial credit. So the factors that pulls the liquidity down are A. Early payments. Sometimes companies voluntarily make early payments to its suppliers, or they may be forced to do so for any reasons such as decreased creditworthiness. This makes outflows quick and thus act as pull on liquidity of the company. It should be noted that there is usually a commercial credit period ranging differently for each industry, and payments are usually not made immediately but after this period. This delay in payment helps in maintaining the liquidity. B. Reduced credit limit. When there is a low amount of credit available or it is available on a tighter term, it reduces the payment lag and may act as a pull on liquidity. Due to tighter credit terms, the time to repay the credit is less, whereas the time for receivables do not change. So, there is an increased frequency of outflows. There may also be reduced credit limits from banks as well, or the credit may be available at a higher rate. This also increases the outflows and impacts the liquidity of a company. The third factor that pulls liquidity is low liquidity position. The liquidity position is the ability of a company to raise cash when needed. It is determined by two factors. One, its ability to convert assets into cash to pay the current liabilities, and second, its debt capacity, When either are low, the company has low liquidity position. So this was LOSB. Check out the study material and question bank on this topic at ProCFA.com. The link for the same is in the description below. If you have any questions, feel free to write to us. We'll get back to you as soon as we can.